Traditional media output, articles, broadcasts, tweets, is typically viewed as a fleeting product. In reality, it's a massive, unstructured data resource, currently decaying. Take the Nairobi Securities Exchange in Kenya. It is a fast-growing frontier market with surging trading volumes, but it operates in an information vacuum. If an institutional or retail trader wants to check the published analyst consensus on a top-tier stock, they cannot. That centralized data simply does not exist here. Nation Media Group's existing infrastructure already generates the raw material for this index. In this NTV newsroom, every broadcast and digital article functions as a high-velocity stream of market data. A confidential internal pitch to NGMG leadership outlines exactly how to harness this engine. It is called the Kenyan Market Sentiment Measurement Program. The proposal maps out a way to convert all that daily media text into a composite sentiment index. The projected ecosystem value of capturing this signal reaches up to 15 billion Kenyan shillings over 5 years. In a financial ecosystem starved for analyst consensus, turning a publisher's output into a validated index installs that media company as the central definitive authority on market reality. To build an index that actually predicts market movement, you have to capture sentiment across the entire participant spectrum. This flowchart shows how we gather that data using 3 distinct inputs. The first pillar ingests 100% of NMG's output, print, digital, and broadcast transcripts, alongside text from major competitors. This captures the prevailing media narrative. The second pillar targets the institutions. We run direct surveys with the portfolio managers who control major pension assets, capturing low-volume, high-conviction data from the people steering the heaviest capital. The final pillar taps directly into retail investors. Using mobile USSD polls and app interactions, the system pulls in high-volume, rapid-fire chatter from individual traders. These distinct groups control immense wealth. Institutional pension holdings alone account for over 200 billion shillings in equities, while platforms like Zidi drive massive volume surges directly from ordinary Kenyans. This ingestion process runs continuously. It requires a daily closed-loop sweep to ensure the data is always fresh. You need all 3 to get an accurate picture. Retail traders provide the volume, institutional managers supply the stability, and the media shapes the broader narrative. Leave one out, and the resulting index is blind to a core market driver. Once those 3 nodes collect the data, it hits the central processing engine. This is where a Python and Hugging Face algorithm block attempts to read and categorize the text. Standard off-the-shelf sentiment models fail here. They process formal English perfectly, but misclassify localized, hybridized dialects. To solve this, the natural language processing pipeline is explicitly fine-tuned. It must accurately interpret Swahili and decode the complex urban slang known as Sheng, translating those local nuances into accurate sentiment scores. Those raw scores are then converted into structured numerical vectors and permanently logged into a high-performance timescale DB storage system. Because automated translation of regional dialects carries inherent margins of error, 10% of this output undergoes a daily human audit to catch false positives. Mastering Swahili and Sheng prevents global data aggregators like Bloomberg from easily replicating the product. By building an algorithm capable of parsing this exact local nuance, NMG creates a localized intelligence asset protected by a high structural barrier to entry. Collecting and scoring this data is only half the equation. For the index to have value, it must mathematically predict where the market is going. To test this, the program outlines a strict 90-day pilot, restricting its focus entirely to the highly liquid banking and financial sector. This limits the test to the heavyweights of the Kenyan economy, like Equity Group. If the sentiment model works, it will work on these highly sensitive, high-volume assets. This chart shows the required kill criteria for the pilot, proving Granger causality. The sentiment data must demonstrate that it physically causes or precedes market action. First, we plot the baseline reality, a blue line representing the historical price and trading volume of the NSE banking sector. Next, we overlay the new composite sentiment index data as a yellow line. Initially, it moves in exact synchronization with the blue market returns, but synchronization isn't enough. The yellow sentiment signal must consistently spike 3 to 7 days before the blue market line reacts. The pilot requires this leading signal to explain at least 10 to 15% of the additional variance in the upcoming trading period. Hitting that statistically significant lead time with a p-value of less than 0.05 changes the nature of the data. The media output immediately stops acting as an audience metric and becomes a tradable, monetizable financial instrument. Once that statistical correlation is validated, the timescale DB data splits into two distinct monetization nodes. The first node points inward. The data feeds directly into a real-time newsroom dashboard, guiding editorial decisions to capture higher engagement and driving a projected 15 to 30% uplift in premium ad revenue. The second node points outward. The data is packaged into an API feed and broadcast product called Market Pulse, creating East Africa's first aggregated consensus index. The locked API generates B2B subscriptions from institutional asset managers, major brokerage firms, and large local corporations. Demand for this critical data comes straight from Nairobi's established corporate infrastructure. Digital-first telecommunications and finance companies require precise behavioral data to navigate local consumer spending and investment trends. Under these two streams, the mid-case financial model projects that the initial 12 to 18 million shilling setup cost is recouped in under 24 months. This dual structure protects the investment. Even if external B2B subscriptions take years to scale, the immediate internal boost to audience engagement and premium ad revenue covers the operating costs. Beyond the 90-day pilot and the 2-year payback period lies a much larger, highly lucrative, long-term strategic horizon. The future of trading in emerging markets relies on localized, autonomous AI investment agents to execute strategies. The primary constraint on these future systems is not computing power. It is the absolute lack of proprietary, time-aligned, localized training data to teach the models how these specific markets behave. Operating this program for 5 years generates a massive, uninterrupted archive of exact Kenyan behavioral sentiment. It creates a proprietary dataset that a global model arriving late to the market simply cannot scrape or synthesize retroactively. The KMSMP is a blueprint for taking a legacy media company and embedding it deeply into a nation's financial system. It turns daily journalism into the cognitive infrastructure that powers the market.